In this video, I'm going to talk about the very good food company that at first made some people look very, very smart and then very, very stupid. And this will be an example of how just because the stock price goes up doesn't mean that you're right, because in the long term, the stock market is a weighing machine. In the short term, it is a popularity contest. If you're new to this channel, my name is Mariusz Konieczny. I run Microcap Explosions, a website dedicated to microcap stocks which are ignored and underfollowed by the investment industry. I also wrote about 10 books on investing, one of which is available for a free download at microcapexplosions.com. I also created valueinvestinguniversity.com, which is a free resource to make you a more intelligent investor. To introduce you to the company, let's have a listen to the CEO.
James here, and this is newly listed on the CSE, and I'm joined by Mitchell Scott from the Very Good Food Company, who's also the Very Good Butcher. And Mitchell's going to tell us a little bit more about his company, which is just listed on the Canadian Securities Exchange. Mitchell, tell us what you guys are up to.
Yeah, so we just listed on the CSE as the Very Good Food Company. So we design plant-based meat alternatives and other plant-based food products, and then take them to market. Currently, we have the Very Good Butchers brand. We've got a range of 15 different meat alternatives with 6 core products. So burgers, sausages, taco stuffer, pepperoni, and a few others.
So these are the company's products. Things like this: hot dogs, burgers. You would see, oh here are the best sellers. So stuff that you would see in a grocery store. I mean, obviously you could buy it online directly from the company, but you would see it in a grocery store.
And we distribute them in a few different ways. So we have a butcher shop retail presence. We ship online across North America by a subscription box model. And then we also have that traditional retail wholesale channel in grocery stores.
So anytime you hear a traditional retail wholesale channel, most of the time, if it's a new company, I would run away right away, because it's a tough business. It's a very competitive type of business. Margins are not great, and when you send the product to the retailers, they don't pay you unless they sell. So it's a tough from the cash flow management perspective.
Right. Why should people be excited about this investment opportunity and more generally the plant-based food movement?
Yeah, so right now, I mean, we're one of the only, I think potentially the first meal alternative company to be listed on a Canadian exchange. And what kind of sets us apart is just really high quality products. So what you go into a nice butcher shop, that kind of a product. So low processed, really natural ingredients. So beans, veggies, herbs and spices, a bit of wheat flour to bind it all together. And we're just really ultra focused on achieving the perfect taste, texture, mouthfeel, and just having that really kind of artisan, handcrafted butcher shop experience.
Okay, so right from the get-go, when you hear craft food, craft anything, craft beer, craft anything, high cost. Think of high cost. People in the retail don't really want to pay a lot for it, so don't ever expect high profit margins for something like this. This is a video from Jeremy for Financial Education on October 27. He introduced this stock to his subscribers, and he first gave reason why.
All right. Alrighty guys, first up here, why a vegan stock? Why am I so excited about this? Why have I been looking in this category? Well, over the past decade, especially over the past, let's say 3 years, the vegan movement has gotten really, really large, okay? If you look at the trends for vegan restaurants, right, it's just up, right? Obviously with that huge dip there, that was because it was peak Rona time at that time and people weren't really trying to eat at restaurants, let's put it that way. But if you look at all these terms, over the past 10 years, they've just gone up and up. Vegan diet, right? Look at that one. Vegan food. What happened in January? What happened right around January 1st, 2017? It messed up literally all these charts. The trend charts around vegan got so messed up. I don't know what happened that day. Maybe some new documentary.
Okay, so the vegan is trending, right? So it seems like a good idea to okay, there's an area that's growing, let's jump on it, let's find a company that maybe can be the next whatever.
Okay, what stock is it? This company is called the Very Good Food Company. Ticker symbol in the States is VRYYF. You have to buy it on the...
Okay, so this is on October 27th, right, somewhere here. So then the stock goes up about 267% from the time of the video. So he looks like a genius. Until he doesn't.
OTC, unless you're going to buy it in the Canadian market. It's a stock that's like $1.70 here today, okay? You know, obviously, that's a pretty low price stock, right? $1 and some change, right? Market cap of a little over $120 million on this one. So like I said, this stock is absolutely speculative. It absolutely is a risk. This is a young company that is very early days. You know, you don't get stocks in this low price brackets unless it is, you know, speculative. Let's just put it that way. This is not a Wynn Resorts. This is not a Tesla Maestro. This is not an FB. This is not a Skyworks Solutions. This isn't some of those stocks I buy and I, you know, do pretty well on. This is more in the planet category. Okay, no doubt about this one. Okay.
Okay, and then on December 17, 2020, somewhere here, somewhere around the peak, he made another video.
Aggressively, where do I kind of chill back a little bit, okay? I am very confident that this will be my next home run stock, okay? And when I say my next home run stock, I'm basically talking about a stock that goes up 100% or more, okay? We have a very, 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 very long list of home run stocks just in the past year or two. Like, it's been ridiculous, okay? And I feel this company I'm sharing with you here today will be my next one, okay? I think this stock...
Okay, so in this video, he's sharing a new company, but before he does that, he's going to show the Very Good Food Company in his portfolio.
Has 2x plus potential in front of it, if not a lot more than that. This is a food company I'm going to tell you about here today, okay? A food-related company. Yeah, it's not a tech stock, although this company is highly innovative. It's not some tech stock or something like that, but this is a food company that I think is going to at least 2x, if not a lot more than that in future years. And it's not Beyond Meat and it's not Very Good Food Company. My other two investments, you guys know I'm invested in Beyond Meat, right? And I'm also invested in a Very Good Food Company.
Right, so this is the Very Good Food Company. When he talked about it, the stock was about 170 something. This is here even after the peak, almost $6. So he still looks like a genius. And in this video, with this high confidence that he has, he's introducing another winner that's going to hopefully go up by 100% to be a winner, right? So which company is that?
Two other companies that are at very different stages, and this company kind of feels like it's in the stage right kind of between Beyond Meat and Very Good Food Company, where Very Good Food Company is very, very early days, right? Beyond Meat's more well established. I feel like this company I'm going to tell you about here today is kind of right in between those two, okay? And no, it's not Coca-Cola. I just happened to see that headline and I was like, oh man, that's rough, okay? This is the most innovative time period we are living through right now in food since the 1940s and 1950s, okay? There's not been this much innovation in this space literally since the 40s and 50s. That's why I am investing in several different companies. You guys know I got the Beyond Meat investment, the Very Good Food, but now I'm adding this one on top. This is going to be 3 super innovative companies that are participating in the food space. But I'm just looking at it and I'm like, this is a historic time we're going through. Literally, since, like, if you guys don't know, basically like fridges, okay, refrigerators, freezers today. I don't think we hit it yesterday, but I think description I might also have that as one of the pinned comments. Alrighty guys, the time has come to divulge of this company. Tattooed Chef Corporation, ticker symbol TTCF on this one.
Okay, so you already saw me make some videos on Tattooed Chef and you know what I think about it, and you already know where the stock price is since this video. So now we know this video is about the Very Good Food Company, and you know, it went from here to here, and then from its peak it is down 96%. So what happened there? Well, let's have a look at the financial statements, and I'm going to first look at the financial statements, kind of what was visible at the time that, you know, he recommended this stock. So in other words, we're gonna have to look at the financial statements from like, you know, not the most earlier ones, but here. Okay, so let's have a look at the balance sheet first. Cash and cash equivalents, 25 million. Accounts receivable, la la la. Inventory, you need inventory, obviously. Total assets, 35 million. Accounts payable, 1.8 million. Lease liabilities, loan payable, only 30,000. So the balance sheet looks okay. We don't have much debt. Total shareholder equity is 27 million. And the market cap, if you remember, was 125 million. So 125 million divided by 27 of equity. So about 4.5 times shareholders' equity. Okay, no problem. Now, when we go to revenue, you can see that the revenue is about 4.6 million. So the market cap was 125 divided by about 4.6 million. So he was paying about 27 times revenues. Now, this is a very confusing income statement to me. It's like procurement expense, fulfillment expense. I know what general administrative expense is. I know what marketing and investor relations is. I know what research and development is. I know what finance expense is. I have no idea what procurement expense is and fulfillment expense. So let's have a look at the notes 8, 9, and 22. Okay, procurement expense. Procurement expense consists of the purchase of the raw materials and inventory, packaging, inbound shipping charges, direct labor, and other attributed overhead expenses incurred in the procurement and manufacturing of the company's finished goods. Inbound shipping charges from suppliers are included in inventory as recognized as procurement expense upon the sale of the product to customer. Procurement expense also include expenses associated with storefront and restaurant operations, including food costs, blah, blah, blah. This, to me, sounds like cost of goods sold, what it costs them to produce it. And then fulfillment expense. Fulfillment expense includes third-party fulfillment costs for picking and packaging of orders, fulfillment, packaging costs, indirect fulfillment, blah, blah. So delivering it, right? Fulfillment expense. Okay, let's go back. So if you look at this, 4.6 million of revenues and 3.8 of it is procurement expense, which to me it's like cost of goods sold. So, okay, so this is like 82% of revenues. So to me, it looks like the gross profit margin, before even fulfilling, before shipping it, it's like 18%. And then you have to have fulfillment expenses. Then you have to have general and administrative, marketing, and investor relations, right? Like this doesn't sound like a great high quality revenues to me. This doesn't sound like a good idea. Unless of course this can come down, but just like what I told you from the beginning, this is not a very good business. Producing this kind of stuff is just, it's always going to be expensive. So, okay, so this is the kind of stuff that he saw if you looked at the financial statements. And he thought it was a great idea to pay 125 million market cap because it's growing. But you see, the thing is that if you have those kinds of low quality revenues, the more you grow them, the more of a liability you have. Because the more you grow, the more expenses you have, the more losses you have. But let's have a look at the financial statements, the most recent ones. What happened? Let's have a look at the income statement. So now it looks like this looks a little bit better. Looks like the gross profit margin is higher than what it was before. It's almost 28%. But look at the fulfillment expense. The fulfillment expense is almost as big as revenues. And look at the general and administrative expenses. 32 million. The revenues are 12 million. Marketing and investor relations alone is as much as the revenues. So in 2021, they lost 55 million. 55 million. And now you see a finance expense of 3 million, which tells you that they had to take on some debt now. And do you want to have debt when you're losing 55 million per year? So let's look at the balance sheet. So as of now, as of December, they have 22 million of cash, and now they have loans, 5.5 million of loans, which before they didn't have it. If we look at the cash flow statement, this is how much they lost on net income after all the adjustments. They lost $45 million of cash per year. So now this has to come from somewhere. And in the investing section activities, you have purchase of property and equipment. So look at this. They spent $12 million on CapEx, right? I mean, they have to build out in order to lower increase their margins, right? So you have to spend money on that. And in addition to losing on operations. So in total, like they had to spend like, 57 million. And where's that money coming from? Well, the money is coming from proceeds from issuance of common shares. So you get diluted. So they diluted by 52 million. They got some money from warrants, and this is where they had to take on more debt. 5 million. Oh boy. Yeah, this is as ugly as it gets. Losing so much money, having to spend money on CapEx, issuing shares to stay afloat, and taking on debt. So now if we look at the market cap, 30 million Canadian, losing money, and 5 million in debt. This thing can go to zero because the 5 million in debt can kill them, take them bankrupt. If they have to issue shares now, they're issuing them at this price. Recently, the CEO was fired, of course, but they have debt now. So this is the kind of stuff that you get if you invest in companies that are terrible to begin with, and you can see it from the beginning. And so when he invested in it here, the market cap was 125 as he showed, right? And from here to here went up 4 times. So it had a market cap of $500 million. $500 million. And he thought it was a great idea to hold it. Well, first of all, he thought it was a great idea to buy it at a market cap of 125 when the company had awful business, because it's a tough business. There's a lot of competition in that business. The margins are awful. Yes, the industry is growing, but so what? There's no switching costs. You can have some repeat business, but there's no switching costs. They don't have any brand. There's no moat at all. And the competition can very easily develop a product like this. And it's losing a ton of money. And to expand and to grow, it costs money. And then the more they grow, it becomes a liability. And so eventually the losses and then the capital raises destroyed the stock. And I don't see any hope here, especially now that they have 5 million of debt, only 30 million of market cap, and they're burning cash, and the margins are not great. So no near-term profitability, I don't think. And now the lenders can foreclose on them. So yeah, that's my analysis.